I mean, the elephant in the room in the a lot of the commodity markets is China. Uh, and whether it's agricultural commodities or base metals or by the way, even precious metals. Who's who's buying a lot of gold right now?
The Chinese central bank.
Yeah, this Chinese central bank. That's one reason that that precious metal is not depressed. By the way, Andy, it's in a bull market, and it's going to stay in a bull market because you have quite a bit of central bank buying, and other even private consumption or buying of gold in China is very heavy. So the macroeconomic picture, you have to look again at what's the model for national income determination. That's a quantity theory of money. What's Hanke's golden growth rate for the quantity of money growth in China? It's about 11% per year. And right now, money supply is growing at about 7.3%. It's very depressed. It's not growing very fast. And what's the CPI? That that by the way, the 11% golden growth rate is a rate consistent with hitting China's inflation target of 3%. That's their, but what is their actual inflation? It's zero. Why is it zero? Because the rate of growth in the money supply is 7.3% year over year. And the rate, Hanke's golden growth rate, consistent with hitting a 3% inflation target, is 11. It's a simple game. And the Chinese have said that they're going to, the Politburo late last year said they're going to start stimulating the economy. We don't know exactly how they're going to do that. My guess is that they're not keeping their eye on the money supply correctly. They've kind of changed. They used to watch the money supply and follow it pretty carefully, but I think they are probably going to engage in a lot of fiscal stimulus, and that's not the way to do it. The fiscal stimulus won't stimulate anything because money dominates. And to get a handle on what do I mean by money dominates? Money dominates over fiscal. All you have to do is look at Japan. Japan, the rate of growth over the last 30 years and the money supply has been totally anemic. And of course, they don't have much of inflation. It's popped up the latest data. But if you look over the last 30 years since 1990, there's been a way below target, no inflation whatsoever. But the money supply has been growing way below Hanke's golden growth rate. And what about the fiscal deficit? The fiscal deficit has exploded. Debt to GDP, it's like 250 or 60%. The ratio, I can't remember exactly what it is, but it's a huge deficit that they've run. But they haven't had any inflation because money dominates. Money dominates. Money's been growing very slowly in Japan, and that's why Japan has no inflation. That's why Japan's had very slow growth for the last 30 years, and it has been dead in the water. And so I think that China could very well get into kind of a Japanese trap.
How do they avoid that, if you would?
Well, they can avoid it by getting the money supply growth up to around 11% per year. They should be focusing on the rate of growth in the money supply, paying attention to that. It's all about the money supply. These broad macroeconomic things are usually dominated by the money supply.
Okay, so then let's game that out then with money supply contracting, if you would, or being, in China as well as Japan, and also falling in the US here. What does that mean for specifically oil? Talk to me about that. And there's also so much going on with oil. You got geopolitical events, you have supply and demand issues, if you would. But is that all related to the money supply as well? The price of oil?
Well, uh, uh, yeah, but let's now get in. Remember, Andy, you said you noticed me trading commodities some 30 years ago. Actually, it's more like the first really big trade I made was the Friedberg Mercantile Group, where I developed a little model for OPEC in late 1985 and concluded that OPEC was going to collapse. And oil prices, I said at the time, would go below $10 a barrel. They did.
Yeah.
And we had huge short positions. We had about 70% of the short interest in the London market in oil. So we had massive positions, and we were short the Saudi Rial and Kuwait dinar too. But so
Well done.
I've been around the oil market for a while. As they say, I've been at that rodeo before. So what's going on? You have to view it just as a simple supply and demand kind of thing, and it looks like the number one, OPEC has quite a bit of excess capacity, so that's one factor. The other factor is that the increment in demand anticipated for 2025 is all going to be filled by an incremental increase in non-OPEC production. So my bias, and I think also that the crude oil demand in China, we were just talking about China, is probably peaked out. So that's kind of the picture, and that picture leaves you with what? I have a downward bias in oil. If of course many things can erupt, the war or something, the Iranians block the Strait of Hormuz or something like that. I'm not talking about that. I'm just talking about supply and demand. The basic fundamentals look to me like they are pointing towards weaker oil prices.
With all things being equal, a weaker.
All things being equal, as they say, ceteris paribus, we've got oil prices probably biased on the downward side.
Okay, so that also would be negative for, correct me if I'm wrong, industrial metals such as nickel, zinc, copper. Correct.
Picture changes a little bit because remember, I started this thing by saying OPEC has a huge amount of excess capacity. So, and you've got non-OPEC players filling the, accommodating the new demand that's coming in. So that's fine. Now, let's look at copper, for example. That's a base metal. My bias would be up, down, and it would be up because, for example, China is, as we go into the green zone, which China is big time, it requires a lot of copper. Or artificial intelligence and more energy use and
Right.
all of these things. There are a lot of things that put a plus in the demand for copper, and on the supply side, it takes a hell of a lot of time before you can open a copper mine and
Yeah.
increase the incremental production. Now, remember, oil, that's not the case. We if OPEC turned it on, they could put they could flood the zone with oil. That's not the case with copper. So my bias there would be up. If we go to soft commodities, again, it's supply and demand, supply and demand. Now we're getting demand, relative prices. Before, the monetary thing was aggregate price levels moving, a whole bunch of stuff moving up and down. You get into these commodity markets, they're all relative prices. Oil is a relative price thing, supply and demand. Copper, relative price thing, supply and demand. Soft commodities, cocoa. It's a huge short supply issue, and consumers of cocoa, Hershey's, and these outfits are scrambling around trying to get uh, they're trying to get find supply, scrambling all over the place. So my price bias would be up. Live cattle. Let's move to live cattle. That's supply and demand in the United States. Herds are shrinking. Supply is shrinking. So where's my bias? Well, it would be up. So iron and steel. Who's a big who's the elephant in the room? Well, it's China, and China's housing market